Las Vegas is a city that thrives on dreams, where fortunes can change overnight. Among its towering hotels and bustling casinos, Caesars Entertainment stands out as a symbol of luxury and excess. But beneath the glitz and glamour lies a story of ambition, greed, and power struggles, culminating in one of the most brutal corporate battles in Wall Street history. This narrative revolves around the dramatic events of 2015 when Caesars filed for Chapter 11 bankruptcy, setting off a fierce showdown between legendary private equity firms and relentless hedge fund titans. The battle for control of this iconic casino empire revealed not only the ruthless nature of corporate finance, but also the vulnerabilities of even the most celebrated institutions in the industry. Caesars Entertainment's roots trace back to 1937 when Bill Harrah founded a small bingo parlor in Reno, Nevada. This humble beginning laid the foundation for what would become one of the most recognized names in the gaming industry. Over the years, Harrah's vision transformed the bingo parlor into a luxurious casino, establishing itself as a leader in the industry. By the 1960s, the casino industry in Las Vegas was booming, and Harrah's became a major player in this vibrant landscape. The brand expanded rapidly, acquiring other casinos and hotels, culminating in a merger with the famed Caesars Palace in 1969. Throughout the 1980s and 1990s, Caesars Entertainment diversified, acquiring properties in Atlantic City, New Orleans, and beyond. The company expanded its operations to include not just gaming, but also hospitality, entertainment, and dining experiences. This diversification allowed Caesars to weather economic fluctuations more effectively. In the early 2000s, Caesars entered a new era of growth, acquiring additional properties and investing in renovations to enhance customer experiences. The iconic Caesars Palace became synonymous with luxury, attracting celebrities, high rollers, and tourists alike. As the new millennium dawned, private equity began to dominate the corporate landscape. Investment firms like Apollo Global Management and TPG Capital sought to capitalize on undervalued assets, leveraging massive amounts of debt to finance their acquisitions. The appeal of this strategy lay in the potential for substantial returns, but it also carried inherent risks. In 2008, amid a backdrop of soaring valuations and an insatiable appetite for growth, Apollo and TPG orchestrated a monumental leveraged buyout of Caesars Entertainment. Valued at approximately $30 billion, the deal included around $23 billion in debt, a staggering figure that foreshadowed the challenges to come. The acquisition was touted as a bold move, with Apollo and TPG promising to transform Caesars into a more profitable and efficient enterprise. However, the financial landscape was about to shift dramatically. Just months after the acquisition, the financial crisis of 2008 hit, sending shockwaves through the economy. The fallout from the financial crisis was devastating for casinos. With millions of Americans losing their jobs and homes, discretionary spending on entertainment dwindled. Las Vegas felt the impact acutely. Caesars, burdened by debt, found itself in a precarious position. As foot traffic dwindled and high rollers stayed away, Caesars' revenues plummeted. The company's cash flow was severely affected, leading to difficulties in servicing its debt. The private equity firms had envisioned a rapid return on their investment, but the reality was starkly different. By 2015, the situation had become untenable. Caesars was struggling to keep up with its debt obligations, and its financial woes were compounded by a growing sense of desperation among creditors. Facing default, Caesars filed for Chapter 11 bankruptcy protection on January 15, 2015. This decision marked a significant turning point for the company. Once the bankruptcy filing was in motion, the stage was set for a fierce showdown among various factions of creditors. The landscape was complex, with multiple stakeholders vying for their share. At the forefront were two distinct groups. The first, lien creditors, who had priority in repayment, and the unsecured creditors, often left holding the bag. Apollo Global Management. Apollo was heavily invested in the outcome of the bankruptcy proceedings, determined to maintain control over Caesars and protect its interests. TPG Capital. TPG had a significant stake and was motivated to ensure the best possible outcome for its investors. Hedge funds. A group of hedge funds, including Elliott Management and Appaloosa Management, had purchased unsecured debt, and were looking to maximize their returns. With the bankruptcy proceedings underway, various factions began to propose restructuring plans. Apollo sought to give itself greater control while offering some debt relief. The hedge funds countered, arguing that Apollo's plan favored the private equity firms at the expense of other creditors. At the center of the negotiations lay a contentious issue: the valuation of Caesar's assets. Creditors disagreed vehemently over how much the company was worth, shaping the restructuring efforts. As the negotiations progressed, the courtroom became a battleground. Bankruptcy hearings turned into high-stakes events, with legal teams from both sides battling over the merits of their proposals. The judge's role was critical, ensuring that the proceedings remained fair and that all voices were heard. After months of contentious negotiations, a settlement began to take shape. By 2017, the parties reached a compromise that aimed to balance the interests of various creditor classes. This proposed settlement would allow Caesars to reduce its debt significantly and provide a clear path forward for the company. The settlement included a plan for creditors to take an ownership stake in the reorganized Caesars. This demonstrated a willingness to collaborate and find common ground. With the settlement confirmed, Caesars emerged from Chapter 11 bankruptcy by the end of 2017. The company had successfully restructured its debt, shedding a significant portion of its financial burden. Post-bankruptcy, Caesars turned its attention to revitalizing its brand and properties. The company began investing in upgrades and renovations, focusing on enhancing customer experiences. The Caesars Palace Showdown is more than just a story of a corporate restructuring. It's a reflection of the cutthroat world of finance, where power plays and greed often dictate the fate of businesses. In the end, Caesars not only survived, but emerged stronger, ready to reclaim its place in the spotlight of the entertainment capital of the world. It serves as a reminder of the high-stakes nature of corporate America.